Introduction to Options, Part 2. Hello, welcome to Lecture 2 of Option Master. My name is Asad Dasani. Glad to have you with us here. This second lecture is continuing on from our first one, Introduction to Options. So here are the things we are going to cover in this lecture. So I'm going to start by talking about option chains. So last time we looked at how options work, right? We understood what is a call option, what is a put option, and what are the mechanics of these options, right? So thinking about if you place an option trade, what happens when the underlying asset goes up or when it goes down, and so on, right? So what we saw, for example, was that options were limited risk, unlimited reward financial instruments. So the holder of an option faces limited risk. They pay a premium. If you buy a call option, then you make money when the stock goes up, and you lose the premium if the stock goes down. And a put option is the opposite. If you buy a put option, you make money when the stock goes down, and you lose your premium if the stock were to go up. So what we're going to do today is we're going to look at some examples of actual options that trade in the marketplace. So we'll look at what's called an option chain, and I'll define it a little bit later. Once we're done with that, we'll move on to talk about the Income Alert recommendations. So those of you who are subscribed to Income Alert, I want to go through the recommendation process and kind of what to expect with our recommendations, how they work, and how to trade them. And this is a particularly important. I would really encourage you that you do go through this lecture if you're going to be trading our recommendations, simply because there's important information in here, and we'll cover a lot of the kind of nuances and a lot of logistics about how to make these trades. So once I've gone through that, then we'll talk about how to actually place a trade. So what I'm going to do is I'm going to show you an example of how to place a trade with your broker. So we're going to log in to a brokerage account and actually show you what the fields you need to place your trades and so on. And finally, I'll talk about the margin requirements for writing options. So buying options, when you buy an option, you typically just pay the premium. When you write an option, you have to post margin with the exchange to cover potential losses. And the margins work a bit like they do for futures contracts. So I'll talk a little bit about that as well. Alright, so let's get started by talking about option chains. So what is an option chain? Well, we know, for example, that typically there are multiple options that trade on each asset. Right, so in the last lecture we saw the example of the call option, we saw an example of a put option. So that's two types of options that trade. But within calls and puts, you have different calls and different puts as well. So for example, you'll typically have call options for various strike prices, right? So remember, when each option is different depending on its strike price, right? So you typically have multiple options with different strike prices trading on each asset. And the same will hold true for put options. So typically you'll see that there are many call options and many put options trading on the same asset, all with different strikes, and typically it's over a range of strikes. And what an option chain is, it is a nice way that summarizes kind of all the options that trade on a particular asset and allows you to look at them all together. It kind of gives you valuable information about each of them. So they're really useful. You can see them online, and we'll look at an example in a minute. So in addition to in one expiry date, so in this case, one option chain will tell you all the call options and all the put options trading for a particular expiry. Options can also expire on different dates, so you'll typically have options that trade on a monthly cycle. So there'll be options that expire at the end of October, there'll be options that expire at the end of November, at the end of December, and so on. And for each expiry date, will have its own option chain, right? So each expiry date will have its own set of call and put options over that range of strike prices, and this allows us to kind of look at all the options together and compare them. So the first thing hopefully you can see from this is that there's a lot of options that trade for one underlying asset. And that's one of the nice thing about options is that you can devise some really interesting trading strategies, right? Because there are so many different options to choose from, you can combine them in various ways, and you can generate all kinds of trading strategies. Alright, so let's now go ahead and take a look at an option chain in the actual market. Okay, so here we are on the NSE website, and if you just do a Google search for Nifty option chain, then you'll get this page, or you can take the link from here. And here's an example of an option chain. So this is an option. So let's start on the first part here. So here we're viewing option contracts for the Nifty. So this is the Nifty index. These are the options we'll be trading in Income Alert. But obviously there are options for various assets. So we can just take a look at this, and you'll see there are options for all these different indices. So Bank Nifty is another one that's quite popular. Some of these, like the S&P 500, don't really have much trading on them. But the point is, you can view option contracts for these indices. You can also view options for individual stocks. So you can search for your stock here and view the options for that particular stock as well. And then we also have a filter by expiry date. So these options here, this chain, is for options expiring 29th of October 2015. And if you look here, we also have, again, options on a monthly basis, right? So we have here options expiring in October. Here we have options expiring in November, in December, and so on. So let's take a look at this option chain and see what's going on. Here it tells you the underlying index, right? This is the Nifty, and this is saying that these options are for the Nifty index, and the current value of the Nifty is 8,238. Okay, so here you can see on the left side we have call options, calls, and on the right side we have puts, and this middle column here are the strike prices. Alright, so for each strike price, there's a call option and there's a put option that's trading. Alright, so let's go ahead and look at options that are close to the current value of the Nifty. Right, so let's, for example, look at an option with a strike price of 8,200. So I'll follow this strike price column down, all the way down to 8,200. And here we can see there's a call option and a put option, and we can kind of look at what these fields mean. So look, in the case of the call option, we have the following fields. Starting with, we have open interest. Right, this is the number of outstanding contracts that are out there. The change in open interest, that's just the change in open interest from one day to the next. We have the volume, that's the number of options that have been traded. So you can see there's 800,000 options traded, that's 8 lakh options, so that's quite a lot. So the Nifty options tend to have the highest volume. We have the IV, which is the implied volatility. This is something we'll talk about in future lectures. We have LTP, which is the last traded price. So this is an important number. So this tells you the price of this option, or the last traded price of that option. That's, say, 116.5. The net change, this is going to be the daily movement on the option. So this option increased by 33.65 today. And then here we have the bid quantity, the bid price, the ask price, and the ask quantity. So when you're actually buying an option, you pay the bid-ask spread, right? So if you're buying an option, you're going to buy at the ask. You're going to buy at 116.5. When you sell, you'll be selling at the bid, which is 115.6. Okay, that's like with any stock, anything you trade. You have to pay that small spread. And the quantity here just tells you how many of each option is available. Alright, so that's the call option. And now we can go ahead and look at the put option, and you'll see all the fields are very much similar. So again, we have the bid quantity, the bid price, the ask price, and the ask quantity. So this option, you can buy it for 55.1 or sell it for 54.6. This net change tells you what the option price changed during the day. So this option fell in value by 41.9. And then we have the last traded price, which is the last traded price of the option. And then we have the same fields as before, so the implied volatility, the volume, the change in open interest, and open interest. Okay, so that was one example, and now you can see that there are options across different strike prices. So for example, at the 8,100 strike, again we have a call option, which say has its own price. The last traded price was 191. We have the 8,100 put option, and the last traded price was 32. We have an option that's within a strike price of 8,000, and so on. And every single option has its own associated data to it. Right, and the same will hold true going the other way as well. So going in this direction, the strikes are increasing. We have an option of at 8,300, 8,400, 8,500, and so on. So one thing that's kind of worth noticing here is that if you look at, this is just for Nifty options, you see the 8,200, then you have 8,250, and then 8,300. So typically the options ending in 50 have lower volumes than the ones ending in 100. So you can see the 8,200 has very high volume. The 8,250's volume is a lot lower. Then the 8,300 is high volume. 8,350 is a lot lower, and this one again 8,400 is high. So typically what that's saying is that most people tend to trade the options that are 8,200, 8,300, and so on. Okay, so we can also adjust this. So we can, for example, look at the options expiring in November. And I just do that, and here again, this is going to have its own set of prices, its own set of volumes, implied volatilities, and so on. One thing you'll notice is the volumes are going to be lower, right? So the volumes here are considerably lower. 5,000, 4,000 contracts, which was a lot lower than the options expiring in October. That's typically what you'll find, is that the near-term options are the most liquid. But typically you can still trade options 1 month out, so November options is still fine to trade in October. Once you get out to December, then the volume tends to fall off quite a lot. So here you can see, for example, the volumes are quite low. The bid-ask spreads are quite high. So typically we don't normally trade options out to this kind of maturity. But again, you can look at this, you can see the different prices, the different options that are available, and so on. So as I said, in addition to the Nifty, there's other options you can look at. So for example, there's the Bank Nifty. We can go to that. The Bank Nifty is an index that's currently traded at 17,900, and again, it has options at various different intervals. So 18,000, for example, 18,100, and so on. And each of these options again is going to have the same information, right? Bid price, ask price, change, last traded price, implied volatility, volume, and so on. All right, so this option chain is really the place to look at when you want to look at the prices of different options. So when you're doing a trade that requires multiple options to be traded at the same time, you typically can look at this and you can kind of see all the options together that you're going to be trading. So one final thing. You can also search for options on an underlying stock. So let's just take an example. Suppose I look at Maruti. So the underlying stock is Maruti, which is trading at 4,447, and this has options trading on it. You can see that the options for these stocks are also reasonably volume. So volume for the put option is 1,000, volume for the call option 1,500, 3,000, and so on. So different stocks will have different volumes. Typically the larger stocks will have higher volumes, the smaller stocks may not have much volume, and so on. So when you want to trade a particular stock option, it's good to look at the option chain and look at the volumes for that stock. You typically don't want to be trading options on stocks that are very low volume, right? Because then your trading costs will be quite high. Okay. So I encourage you to take a look at this on your own. Like I said, you can just Google Nifty option chain, and here you'll get the options for all the stocks and indices on the NSE. You can also find options on the BSE that will have its own option chain associated with it. You can find currency options, basically all kinds of options. Every single option contract will have some kind of chain that you can look at and you can use to determine the prices and information for different options. Income alert recommendations. So in this part of the lecture, let's talk about how the income alert recommendations are going to work. So if you signed up for the service, then here's what you should expect. And for those of you who have just signed up, we'll be starting recommendations on the 26th of October. So recommendations will arrive in your email inbox overnight. Okay, so I will be sending them during the hours that markets are closed, and you could get recommendations on any day that is a trading day. Okay, so this means that you could get recommendations Monday morning through Friday morning, unless there are holidays. And I'll be sending them overnight, so typically you may get the Monday recommendation on a Sunday, and the Tuesday recommendation may come late on Monday or something like that. I'll do my best to send it as early as possible, so it's possible you may get them late the night before. Typically each recommendation will involve multiple trades. Okay, so the kind of strategies we do here at Income Alert is very much about trading combinations of options. So we will trade call options and put options at the same time. And also we're typically writing options, so those two things. So we could have 2 trades at the same time, we could have 4 trades at the same time, we could have 6. It really just depends on the market conditions at the time. So what should you do once you get the recommendation? So when you get the recommendation overnight, trades should then be executed when markets open in the morning. Okay? And there's no fixed timing here that you need to execute the trades. But we recommend executing it soon after the market opens. You don't necessarily need to execute it beforehand. You can wait until the market opens. That's fine. We're going to be calculating our performance. So on the Income Alert website, where you'll see all our recommendations listed, and you'll see the open prices and the close prices and the returns and so on. We're going to be using opening and closing prices, assuming that trades are taken at 9:30 in the morning. Okay. So the market opens at 9:15. So this is for Nifty options. The market opens at 9:15. So we're going to assume that trading is taking place at 9:30, and we'll be reporting performance based on that. So as I said, that doesn't mean you have to execute the trades right at 9:30, but do execute them in the morning as early as possible. If you're before 9:30, that's fine. Even if you're after 9:30, that's also okay. Okay, but earlier is better, and morning is better. And if you're within a few minutes of the time of 9:30, your performance will be very, very similar to what we actually report, unless there's a lot of movement over a very short space of time. Typically when the market opens, there's a lot of movement in the first few minutes. So we try and avoid that. So we normally trade after the first few minutes are done, when the markets calm down a little bit. And after that is probably a good time to trade. So at least after 5 minutes after the markets have opened, when they've calmed down a little bit, and that's a good time to place your trades. And again, if you missed 9:30, it's okay. You can place them at 9:40. You can place them at 10. You can even place them at 11 o'clock. It doesn't matter, but earlier is better. Okay, so a little bit more about the trade details. So we'll be sending alerts, which will come to you by email, only when a trade needs to be made. And this will not necessarily be every single day. So if we don't send an alert, that means you don't need to change anything. Right? So suppose we have a trade open, but we don't send any alert, then you just hold on to that trade. You don't change anything. If we have no trades open and there's no alert, then you don't need to trade again. Okay? So essentially, you should trade only when an alert is sent, and we will send alerts only when a trade needs to be made. So what about when you're actually making the trades? Well, in this case, you should be using market orders to execute trades. A market order means that you execute the trade at whatever the current market price is. The opposite is a limit order, where you specify the price you want to execute the trade at. But we're going to be using market orders, so you execute the trade at whatever the current market price is. And it's very important to execute all the trades together. I'll talk a little bit more about why this is later. Next, we won't have target prices or stop losses for individual option contracts. The reason for this is that typically options are not traded in this manner. The reason being is that when we make our trades, so we'll be trading call options and put options at the same time, and it's often the case that one is used to hedge the other. So we'll usually expect one to make a loss and one to make a gain, and aim to make a gain overall. And we don't want to be closing one leg and opening and keeping the other leg open if one has made money and the other has lost money. So typically we don't apply this kind of rule to trading options. Instead, we adjust positions based on the value of the Nifty index. So rather than the value of individual option prices, the trades you make will be determined by how the Nifty index moves. Alright, and what you'll find is that when there's a large movement in the index, our trades will typically lose money, and in that case we'll typically close out the trades and open new ones. If there's a small movement, we'll typically not be changing our positions. That's when we'll make money, and that's when it's a good scenario. So remember, we're just going to be sending you the recommendations to trade these options. You just trade them at the market price, whatever the price is in the morning. It doesn't matter what the price is. Just trade it at whatever the market price is at 9:15 or 9:30. And again, we'll be adjusting our option positions based on what the Nifty index is doing on a day-to-day basis. Alright, now let's look at some examples. So here's one example of a recommendation. So the first line is what the recommendation is. So the recommendation will look something like this. Open, short, November, Nifty, 8,200 put. Okay, now let's break this down and understand which each term means. So the first two words, open, short. Open means we're going to initiate a new position. Okay. Short means we're going to initiate a short position. Short means we're going to sell the option, right? So that's so long means you buy, short means you sell. So that's the same terminology used in futures. Open short means we're going to initiate a new short position, or we're going to sell the option, right? So when I say open short, it means you go and sell that option. The next term, November, that refers to the expiry month of the option that we're going to trade. So you saw in the option chain, we saw options trading in October and options trading in November. And we'll specify the month of the option that we want to be trading. The month is important, it does matter. So if we say November, you should trade the November contract, not the October one, not the December one. It does matter. So that'll be the expiry month. Nifty is the underlying asset. In our case, we're always going to be trading Nifty options, so this will always be Nifty. But you know, in theory, you could have options on different assets like the Bank Nifty or other stocks and so on. 8,200, that's the strike price. Okay, so remember we saw in the option chain there were different strike prices for each option. There were different strike prices for the Nifty index. We had the 8,200, we had 8,100, we had 8,300, and so on. So this means we're trading the option with the strike price of 8,200. And the final word is put, and that's going to be the option type. So that could either be call or put. Put means we're trading the put option. Call means we're trading the call option. So that's pretty self-explanatory. Now let's look at a couple of other examples. So in the last example, we said open short November Nifty 8,200 put, and suppose we open that on day 1, and then on day 2 you get another recommendation that says close short November Nifty 8,200 put. So close short means exit your existing short position, right? So in the first case we had open short. Open short means initiate or begin a new short position. Close short means exit or get out of an existing short position. So close is always going to mean we're squaring off the position. Okay, so if you've sold the option, it means you're going to buy it back and your position will be squared off. Alright, so close short means exit existing short position. And since we're going to be selling options, all our recommendations will either say open short, either enter into a new short position, or close short, get out of an existing short position. If we were also buying options, we would use long instead of short. Right? If we were buying options, we'd say open long, that would mean enter into a new long position, or we would say close long would mean exit existing long position. But again, because we're only writing options in the income product, we'll always be dealing with short positions, so you'll either see open short or you'll see close short. Now let's look at another example. Open short November Nifty 8,000 call. So here let's look at what changed from the previous recommendation we looked at. So open short is the same thing, right? We're going to enter into a new short position. November is again the expiry month of the contract. Nifty is the underlying asset. And this time, instead of 8,200, we're going to have the strike price as 8,000. Okay, so this means we're trading the option with a strike price of 8,000. And here we're going to have a call option instead of a put. Okay, so here we're trading the call option with a strike price of 8,000. All right, and we're going to short that option. So just the difference with this recommendation and the one before is the change in strike and the change in option type. Okay, so it's very important to keep attention to those things, right? So those are things that will change regularly: the strike price and the option type. We'll be trading both calls and puts, and we'll be trading across a range of strike prices. Okay, the word Nifty will always be there. November will change on a monthly basis which options we're trading, and again, short positions will always be doing short positions. Either we're opening them or we're closing them. All right, let's look at a final example. So here's an example that you might actually see in practice in terms of the number of trades we're doing here. So recommendation example 3. So I'm going to assume that we open those two positions we mentioned before. All right. So earlier, it's not the same positions, but suppose we opened two positions before. Suppose we opened the 8,000 put and the 8,200 call. So a recommendation you might see might look something like this. So the first line might say close short November Nifty 8,200 call, close short November Nifty 8,000 put. All right. So suppose those are the trades we opened before. First thing you might see is saying close out both of those trades that we made. Okay, and here we're closing out the call option with a strike price of 8,200, and we're closing out or squaring off the put option with the strike price of 8,000. And then you might see two additional trades to make, right? So in this case, we're saying open short November Nifty 8,300 call, right? So this means we're entering into a new short position. The expiry date is November, underlying asset is Nifty, strike price is 8,300, and the option type is a call. And we're also going to open short November Nifty 8,100 put. So we're going to be entering into a new short position. Again, November expiry, Nifty is the underlying, strike price is 8,100, and the option type is a put. Alright, so this is kind of, you should typically expect to see a few lines with each recommendation, right? Some recommendations will have many lines, multiple trades. Some may only have one or two. Again, it's going to vary depending on the market conditions. But again, we'll be listing all the trades to make one for each line. And a couple of other very important points here. It's important to execute all the trades at the same time. Okay, what this means is that you should place all the trades together. Sometimes brokers allow you to trade all of them together. Sometimes you have to do one at a time. It's fine if you need to trade it one at a time, but then just do them one after another. Okay. The reason is that we hold call and put options at the same time because one is a hedge to the other. Right. That's what keeps our risk low. So it's very important that you don't want to have only one portion of the trade open for a long period of time. So try and trade them all together. Okay. Either trade them all together or trade them one after the other. You don't need to rush to do it. Okay. You can trade them within a couple of minutes of each other. That's fine. Right, but don't trade one and then trade another one 2 hours later. Right, trade them one after the other, and essentially you only want to be trading once a day. You don't want to have to trade multiple times during the day. And another very important point is do not execute only part of the trade. This is very important. So if we tell you to sell a call option and sell a put option, don't just do one of them. If you only do one of them, then you're actually exposing yourself to a lot of risk. All right, and that's not the strategy that we're doing. Obviously, if you're doing a strategy on your own, it's perfectly fine to trade one option at a time. That may be the strategy that you want to do. But when we send out multiple trades, so when we send out trade the 8,300 call and the 8,100 put, it's really important to not execute only one of them. You need to do both. If you don't feel like trading at all, you can have nothing open. That's fine. You can close all your positions if that's what you want to do. But don't trade only part of it. If you're going to trade it, make sure you trade all the recommendations exactly as they are. So in this next part, we're going to talk a little bit first about lot size and trading capital. So how much capital you need to trade the income alert recommendations. And then what we're going to do is we're going to talk about brokers, how to choose one, and then I'll show you an example of how to make a trade with a particular broker. So let's start by talking about lot size and trading capital. So the first thing to note is that the lot size for Nifty options, okay, is 75. This is from November onwards, so the October options have a lot size of 25. October and beforehand, they recently increased the lot size to 75, so we'll be starting with the November contracts. So for our cases, it'll always be 75, and then going forward, the lot size will be 75. And we recommend a trading capital of 5 lakhs per lot traded. Okay, so earlier in the recommendations, I said, you'll do things like sell, for example, 8,000 call option or 8,200 put option, and so on. So when you make this trade, you're going to have to specify how many lots you want to trade. Okay, and our recommendation is that you have 5 lakhs of trading capital per lot that you're going to trade. So this means trade 1 lot if your capital is 5 lakhs, trade 2 lots if your capital is 10 lakhs, trade 3 lots if your capital is 15 lakhs, 4 lots if your capital is 20 lakhs, and so on. So we're going to be reporting performance assuming a 10 lakh portfolio and 2 lots traded. So one thing we did mention when we were talking about income alert before was that we do recommend 10 lakhs rather than 5. The main reason for this is that it's going to be a lot easier to recover your subscription fees, and still make a strong profit if you have 10 lakhs rather than 5. So that's why we recommended 10. But it is still possible to trade with 5. You could still expect to make a profit above your subscription fees with the 5 lakhs of capital. But a good number, I think, is 10 lakhs is ideally what you should have. If you have 5 now, it's fine. One thing you may want to do is if you just want to test the waters initially, you can start with 5, and then a couple months later you can increase it. So you can also do that. But yeah, just remember the basic rule: 5 lakhs per lot. So this is a lot more than the margin requirements for the options, which we'll talk about later. The reason we have the capital requirements is twofold. One is that we're typically trading multiple options at the same time. So sometimes we may have 4 or 6 options open at once. So you need to have enough capital to be able to handle the margin for all of those options. So we may easily have 4 options. Sometimes we may have 6. Sometimes we may have 2. So that's why we need this flexibility of a large enough capital base to be able to make these trades. Okay, and the other is that trading is risky. And sometimes if the market is very volatile, you can lose money, you could lose a lot of money. And we don't want to put ourselves in a position where if we have a bad loss, then our trading capital is heavily impacted. Okay, so that's kind of the other motivation for having a solid capital base. It just means that you're able to withstand market turbulence, which does happen from time to time, and we cannot really predict when it's going to happen. But it's good to be in a position to be able to withstand it. So those are the 2 reasons we recommend we have this 5 lakhs per lot traded, right? One is that to protect yourself against losses, and the other is that because we're trading typically many options at once, okay, and that often means that you actually need a lot of that capital as margin. Okay, so let's now go ahead and talk about brokers. So choosing a broker, there's really just a few things to keep in mind here. Obviously, we cannot pick a broker for you. That's up to you. We do have a broker's guide available, which you can take a look at, and that'll tell you what features the different brokers have. The only thing we don't have is commission rates, but all the other features are available, and you essentially need the functionality to be able to trade NSE futures and options. So if you have the functionality to trade futures, you probably have the functionality to trade options as well, because they usually come together. Most brokers, at least the ones that are listed on our guide, I believe they all offer NSE futures and options. So if you have one of those brokers, you should be fine. So that's the first thing. And obviously, if you already have a broker that you trade from, it's probably going to be easiest to use them. But you may also open a new account. That's up to you. One thing that we would like to point out is that we do trade quite frequently in this particular strategy. Right, so we're making option trades on often a daily basis, sometimes every day, sometimes every 2 days, and so on. because we're making lots of trades, those commission rates are actually quite important. So normally, for example, if you were trading a low frequency strategy, so if you were trading weekly or every 2 weeks or something like that, or less often than that, then I would say that the commission rates don't have a big impact, if you're not trading very often. But in a strategy like this one, where we are trading quite frequently, the commission rates will matter more. Alright, so this means that low commission rates will help. That doesn't mean you have to go to the broker which has the cheapest commissions. Like I said, if you already have a broker that you already work with and you already make your trades with, it's probably best to stick with them, unless their commissions are very high. So the way I might phrase this, rather than find the cheapest broker, I would really just advise you, don't go with brokers that have very high commissions. Okay, because for this kind of strategy, those commission rates will matter. And obviously, the lower the commission rates, the better. Okay, so now what we'll do is we will look at an example of how to place a trade. So here we have an account with Sharekhan, and we're going to show you kind of how to navigate. We'll show you with this particular broker how to place an options trade, and my guess is that it should be similar to your own brokers. The formats may be different, but a lot of the fields will be the same. So let's go ahead and we'll take a look at that now. Alright, so here we are in Sharekhan, and you can get to this by going to the Trade Now section. So if you have an account with them, then obviously this is going to be the most helpful for you. But like I said, I think a lot of the fields will be similar. And then what we'll do is we can look at the different options they have here. So they have NSE, BSE. NSE FO is NSE Futures and Options. That's the one we're going to want. Just for information, MCX is the commodities, NCDX is also commodities, and then we have currencies on NSE and MCX SX. So we're going to go to NSE FO here. Then we have script. You can either trade the futures contracts or the call option or the put option. So let's say we want to trade the call option. Then script name, I'm just going to type in Nifty, and that should work. Yep, so we have Nifty expiring in October, Nifty expiring in November, and so on. So let's say we want to trade Nifty expiring in November. Then I can enter a strike price. Suppose I want 8,200. So I can click on that. And then what you'll see here is that it will give you the current price of this particular option. Right, so this price right now is 225.4, and here you have the order book. So this is the bids and the asks. So note that we are outside of market hours right now, so markets are currently closed. So if you place an order now, it won't work, but it will execute on when the market's open. So the first thing to note is that your order quantity here, that's 75. So this is going to be the lot size. So 75 means you're trading one contract. Okay, because remember the Nifty lot size is 75. So you put 75 for one contract. If you want to trade two contracts, you would put in 150. So let's say I wanted to trade two contracts, I would put in, say, 150, and that would be fine. You can buy or sell. Suppose I want to sell. And then I have two options for validity. One is GFD, which I believe is good for the day. The other is IOC, which is immediate or cancel. These are only applicable. These you should just use the good for day, so it's valid until it gets executed. This is not really an issue unless you're doing limit orders, which may not get executed right away. But we're going to use a market order, so we should change this to market order. The stop loss trigger price and limit price you can leave blank, and this order type can be GFD. And then you would simply press place new order, and then you would be good to go. Okay, so that's how you would make a trade in this example. I'm obviously not going to do it here, but once you place the order, then you should probably just have to confirm it, and then you'll be done. Okay, so that's how to trade a single option at one time. So also, Sharekhan has the facility to trade multiple options at once. This is going to be useful because all our trades are typically multiple options at the same time. So what you can do is you can actually go in to option chain. Okay, and here I have, so I'm going to look at the Nifty options expiring in November. Let's check Nifty to November, and here I have all the options on different strike prices. Okay, so this looks very similar to that Nifty option chain we saw before, and that's exactly what this is. This is an option chain, again with kind of the same information that we saw before. So suppose we wanted to trade two options at once. So suppose I want to trade the 8,300 call, okay, and the 8,200 put. So I'll put a check next to the 8,300 call. Right, calls are on this side. Put a check next to the 8,200 put. Okay. Then I can click on place trade. All right, and this what's nice is that it allows you to trade multiple options together. So order type, again, we're going to be selling. So quantity will be 75. Again, 75 is for one contract. If you wanted to trade two contracts, you could change that to 150. So suppose you did 150 and 150. This disclosed quantity, that's a field you can just leave at 0. This is referring to if you're placing a limit order and you want to know how many shares should be actually disclosed to the market versus not disclosed. Again, we don't need to worry about that. You can leave that blank. These are the last traded prices, and then trigger price, again, 0 means market order, so we'll leave that at 0. And validity, again, we'll just do good for day. We'll leave that as it is. And then you can just press place new order, and then you'll have you'll be able to trade both of these options at once. And I'm guessing that the other brokers should have this facility as well. You can trade multiple options at the same time. This is the best thing to do actually when you're placing these orders, because like I said, it's helpful if we're trading, because these are all meant to be hedges, so one option is a hedge to another, and they do need to be open at the same time. It's typically good if you can do these types of basket orders, right? Which is exactly what this is. Okay, so one last thing. Again, I can go back to the option chain here, and if you wanted to trade even more options, you could. So for example, again, let's say I'm trading November, and say this time I want the 8,200 call, the 8,300 call, and the 8,200 put, and then the 8,300 put. I could go into place a trade, and this time all 4 options would be available, right? So it may be the case that sometimes I want to buy, sometimes I want to sell, so I can be buying options and selling some options. So imagine we're closing out one set of trades and opening a new set, then some would be buy, some would be sell. And again, all these fields will be the same. So again, 75 is for one lot, 150 is for 2 lots, and so on. And then everything else is quite straightforward. So because we're doing market orders, again, we don't need to worry about too many of the fields here. You just place the orders when the market's open, and then you're good to go. And you'll see the way the contract looks is very similar to how we recommend it, right? We're saying November is going to be this expiry. PE is put option. CE is call option. That's one thing to keep in mind. That's the terminology that's used. The E stands for European. So CE means a European call option. PE means a European put option. There are 2 types of put options, 2 types of options, European and American options. I'll talk about those in a future lecture. They're not too much to worry about at this point. So just remember, CE is call, and PE is put, and then once you're here, you can place your trade. In the last part of this lecture, I want to talk a little bit about the difference between buying and selling options, and the concept of margin and margin requirements. Let's start by talking about what happens when you buy an option. Now, when you buy an option, you must pay the full premium, right? So options have a price, or the premium. That's the same thing, right? So when we looked at the option chain, the price of those options, that's the same thing as the premium. When you buy an option, you essentially pay that premium, right? So if the option premium was 100, your lot size was 75, then it would cost you 7,500. And that would be all you need to do. However, when you sell an option, it's a little different. Instead of paying the premium, you actually receive the premium, but you have to post margin. Okay? And the margin is an amount of money held with your broker to cover potential losses on your trade. So typically, when you write an option, the income you receive from the option will be used for the margin, and you will also have to post additional margin from your account to cover future losses. And this is just there to cover potential losses. We'll go through an example of how that works. And margin requirements are set by the exchange. So typically there'll be some fraction of a contract value, of the value of a contract, and they may also vary by broker. Different brokers will have different margin requirements. And a lot like how you would, what would happen when you're trading futures, it's going to be there to cover the day-to-day fluctuations in the trade. So when you're selling options, you have to be aware of margin, right? When you're buying options, you don't need to be aware of it, but when you're writing options or selling options, margin becomes quite important. Now let's go through a hypothetical example of what margin requirements might look like. So suppose you sell a Nifty option, okay, and the margin requirement is 8% of the contract value. Now, again, this is just a hypothetical number. It could be more, it could be less. This is typically the maximum it will be. So 8% is the margin for the futures contract, which is typically a little higher than the options contract. So 8% is typically as high as it should be. It'll usually be less than this. But again, that can change if if market conditions change. But let's just suppose, for example, that the margin requirement is 8% of the contract value. So if the Nifty is trading at 8,000 and the lot size is 75, you're going to have to post a margin of 48,000 rupees. So how do we get to this number? Well, this is 8,000 times 75 times 8%. Okay? So you see roughly 50,000 rupees for the contract. Again, this is the maximum it will be. In practice, it'll usually always be lower than this. This is sort of the margin requirement in the highest scenario. Margins also do vary by strike price. They do vary by contract expiry and by broker. So different options with different strike prices will have different margins. Like I said, I think it'll typically be less than this amount, so it'll be somewhere below this amount. But it does vary by what option you're trading, and what option you're trading. Obviously, there are call options, there are put options, there are different strikes, there are different expiries, and so on. Brokers may also request their own margin that's additional, and so on, which they may want to cover losses. And these margins change on a daily basis, right? So today's margin may be 8%. Tomorrow's margin may be 9%, the next day might be 7%, and so on. Okay, so it's not necessarily the easiest thing to keep track, but typically your broker will have will tell you what the margins are, and we're going to actually go online and look at one example where we can see what the actual margins are for various option contracts. So when we're talking about margin requirements, I want to just clear some misconceptions about what we mean by margin. So margin is not the minimum, is not basically the amount that you have to make the trade. You typically need more than that in your account to actually make a trade. And let me show you why. So first of all, when you write an option, the income you received will be used automatically as margin, right? So that forms part of the margin. And then you're going to post some additional margin that your broker requires on top of the income received from the option. Okay, so typically the income received from the option will offset sort of that 48,000 we mentioned before, and the remaining margin you'll have to post. So the way margin trading works is that let's say you've made your trade, you've posted your margin. Anytime your trade makes money, okay, your account gets credited, right? So let's say your current account value is 5 lakhs. You've traded one contract, it moves in your favor. Let's say you make 10,000. you're still going to have the same margin for the contract that you have, but your account will be credited some money because your trade made money. All right. However, when your trade loses money, the opposite is going to happen. Your account's going to be debited, and you'll have to post additional margin. Okay. So suppose you initially posted a certain amount of margin for a contract, it loses money. Okay. You have to still keep that margin at the same level, right? So you're going to have to pay up whatever the loss was for the day in order to keep that margin at the same level. All right, and this is the crucial thing about margin that's very, very important. On a day-to-day basis, okay, any time on a particular day that your trade loses money, you have to have enough cash in your account to cover the additional margin requirement. And that happens on a daily basis. So this is why it's so important to keep enough cash in your account to cover margin calls. Okay, typically you should keep many multiples of what you actually need. And that's very, very important, because what you don't want is a situation where you have very little spare cash in your account, almost all of it's tied up in margin, a couple of trades go badly against you, and you're not able to meet the margin requirements. When that happens, your broker will typically close out the trade for you. You may get charged a fine or something like that as well. So it's not a position you want to be in, right? So always keep enough cash in your account to cover margin calls. If you follow our guidelines of 5 lakhs per lot traded, you will be just fine. You'll have more than enough, and you won't need to worry about this. Okay, so you want to have enough cash so that you don't have to worry about posting additional margin. All right, let's take a quick look now at margin calculator. So there's one broker called Zerodha. They're a discount broker, and they have a margin calculator online that's very nice, and that I'm going to show you. Most brokers should be able to tell you what their margin is as well. This one is available easily, so we'll just go take a look at it now. Okay, so here this is called the Zerodha margin span margin calculator. If you just do a Google search for it, you'll find it, or the URL is right here if you want to type it in. So again, NFO is going to be Nifty futures and options. That's what we're looking at. So let's start with just a futures contract. So suppose I'm trading the Nifty. Now again, you can select whatever you want here. Suppose I want Nifty for November. Okay. Quantity is 75, so that's the lot size. This is one lot, and I can add this here, and it'll tell me the margin for that particular lot. So here you can see that the span margin is 43,000, exposure margin 18,000, total margin 62,518, and you can kind of see what the explanations for each of these things are. So there's typically there's multiple sources of margin that you have to be aware of. Okay, and this would be the margin requirements for this particular futures contract. Okay, so let's take a look, for example, at an option, because that's what we'll actually be trading. So with options, again, we have the symbol, and we can do call options or put options, and we can see what the margin would be for a particular call or put. So suppose I'm looking at the 8,200 call option. I can add this. Actually, what we want to do is let's reset it first to take out the futures contract, because it actually calculates the joint margin together, and I'll come to that in a second. So going back to the Nifty, so Nifty in November, and I want to trade an option. Let's say a call option with a strike of 8,200. Suppose lot size is 75. Let's suppose we're going to trade 150, so we're trading 2 lots. And of course we need to change this to sell, because with an option there's only margin for selling options, not for buying them. So let's now take a look at a Nifty option. So here we have the Zerodha margin span calculator, and this calculator tells you what the margin requirements are for various futures and options across different exchanges. So I like this one because it's very easy to use. Chances are most brokers should have this facility. They'll tell you what their margin is. So let's take a look, for example, at what the margin requirements would be if you're trading a Nifty option. So change the product to options. The symbol, again, we can look at Nifty here. So let's take the November Nifty contracts. Suppose we have a call option with a strike price of 8,200, and we're going to be selling this option. So remember, buying options doesn't involve any margin, but selling options does. I can click add here, and then it will tell me the margin received, the margin that I need to post for this particular contract. So here you can see for this particular contract, I need to post margin of 32,700. So premium receivable is going to be the amount that you actually receive from writing the option. So you can see this premium that will get credited for short selling the option. And the total margin is going to be what you'll need to post in order to make this particular trade. Okay. Let's try adding another option. Suppose we have a put option with a strike price of, let's say, 8,100. Sorry, let's say 8,300. I can add that. And the margin for that is also quite similar. It's 33,780, and that will be what you need to post for this particular contract. Okay, and like I said, the premium receivable will help you offset some of this, and you'll have to post additional margin on top of the premium you've received. So I'm fairly sure the way this works is that the premium received is used to pay part of the margin, and then the rest you have to pay yourself. And then we can kind of play around with this. Suppose we want to change this. Say we're trading two contracts, and say we have this time an 8,100. I can add this. And then obviously, since here we're trading two contracts, the margin is a little higher, but it's not double, which means that the margin for the 8,100 put is a little bit smaller than, say, the margin for the 8,300 put. Again, that's just because one option is likely to more likely to be exercised in the money than the other. But what you can see here, this is very nice calculator. Allows you to kind of look at what the margin requirements would be if you were trading one of our recommendations. So let's just do one final example. I'm going to say, suppose we look at the recommendations that we talked about earlier in this lecture. So suppose again we're trading the Nifty November, and suppose we're going to sell the 8,100 put, and we're going to trade two lots, so the quantity will be on 150. And then suppose we're going to also sell the 8,300 call option. Again, 150 quantity, two lots. Okay, so from these two options, from this particular trade, right? So this would be one example of a recommendation. What you can see is that the margin requirement is around 55. It's 55,700 for the put, 57,000 for the call. Total is 1.13 lakhs. Okay, and again, this is just two options. So imagine we were trading 4 options in our recommendation. Suppose we also had an 8,200 call and an 8,200 put in addition to this trade. So suppose our trade consisted of these 4 options. Now you can see that the margin requirements are 2.3, 2.4 lakhs for all 4 trades. All right, so this is why we kind of say you should keep a large amount of capital, because if you're trading multiple options at once, then the margin requirements will quickly build up. So I encourage you to take a look at this website. It's very easy, and you can play around and put in different find margins for different underlying assets. There's all the various stocks are in here, all the Nifty, F&O, and it's a really good tool. If you're interested in trading some particular options, you can just use this to figure out what the margin should be. Okay, that now brings us to the conclusion of the second lecture. So in this lecture, we've covered how the income alert recommendation process works and how to place trades. So we started first by looking at the option chain, right? That there was multiple different options trading on the Nifty index or on the underlying asset. And typically, when we're making trades from income alert, we're going to be trading multiple options at once. So we'll be looking at that chain, picking certain options and trading those. So we learned how to make income alert recommendation, how the recommendation process will work. Again, if you're not clear on it, just go back, have a look at that section. As I said, once the recommendations start, hopefully you should be in a position where everything is clear and you're ready to go. We saw how to place a trade with the broker. We saw an example with Sharekhan. And finally, we talked about margin requirements that we just did, and that was on and we saw a calculator that you can use to work out what the margin requirements are for different options. Okay, so this now concludes the first 2 lectures, which have been an introduction to options. Now we're going to move on to some more interesting stuff. We'll start talking about option trading strategies. So we'll have 2 lectures on that. So it will be option trading strategies part 1. That'll be next time. And then the time after that will be option trading strategies part 2. So we'll have 2 lectures on option trading strategies. Here we'll go through some of the, both basic and fairly advanced strategies. So we'll be going through this from beginning to fairly advanced. So now it's going to get a lot more interesting. You'll see how we can combine different options to trade different particular strategies. All right. Okay, so that concludes this week's lecture. Thank you very much for listening, and see you next time.